Good evening, everyone, and welcome to tonight's webinar. Tonight, we're talking about tax tips for the investor. So before we get started, unlike agents, we're real investors providing real support to our members. It's our duty to protect your assets and promote your best interests. To do this, we need a finance broker to provide us with a review of your circumstances, and all of these services are free in the Property Club to protect you. 90% of property investors retire on a part pension and remain poor, but not our members. It's really important to us. We create millionaires, so ask us for our financial wealth check form, which is available in tonight's handout. So in your handout section of the screen, you will have a financial wealth check form and a needs analysis form, which will go into a bit more detail as we work through the webinar tonight. So who are we? So we are Justin and Jenny Watson. We're 35 years old. We both work full time, and we have a 4-year-old toddler, Olivia, and a 9-month-old Penelope. We joined the club back in 2009, and we became property millionaires back in 2012, meaning that we had over $1 million worth of property. We became property mentors in 2016, and we became mentors basically because we had learned so much on our property journey that we wanted to give back and help others on their investment journey as well. So we then became Young Investors Club ambassadors in 2016, and then Young Investors Club presidents in 2018. And it's important to note as we talk through our bits of our story tonight that we are on average income, so we're certainly not earning millions of dollars. We do have 5 properties in our portfolio, and we've done all of this just on average incomes with the help of the Property Club. So why are we talking to you? Why have we asked you to come along and listen to us tonight? The reason being, we've worked really hard to build our property portfolio to lead us into retirement. So we're not building a portfolio to help us today. We're building a portfolio so that we have a great future when we retire. We're grateful for the knowledge and the information that's been shared with us to get us to where we are. And our goal is to help others with strategies to build wealth for their future, particularly the younger generation that will need to be self-funding into retirement. It's something that people of the younger generation tend to not think about. It seems so very far away. And there's this misconception that superannuation is going to fund everything that we need once we're no longer working. So in previous months, we've talked about the role that property plays in retirement. By building your property portfolio, you'll have an asset base that will financially support you. And it's important to do this because superannuation and the pension is simply not going to cut it into the future. Have a think about how much you've got in your super account, and have a think about how much you spend each year on things that you need and things that you want to do. And ask yourself if your superannuation by the time you get to 67, if that's going to cut it. There's a lot more methodology that goes in behind these calculations, such as inflation. But even on the bare basics, you do the simple math and it just doesn't work out. So that's why you need to take action and you need to create your own wealth base. And that's where property comes in. But how does tax affect that? So tonight we're going to talk about tax and property from the following perspectives. So prepping for this financial year and quick tips for preparing for tax time next year. But before we do that, we do need to understand the impact that tax has on property and what impact property has on tax. As we know, tax is a major part of life, which is always going to be an obligation. And for the most part, it does really feel great to be a part of our economic system contributing to society. But there are times where you have to wonder how far ahead you would be if you didn't have to pay as much tax as you do. So just how much tax are you likely to pay in your lifetime? Well, here's a bit of a breakdown. So let's say you earn $70,000 a year and you're currently 30 years of age. Retirement age now being around 67, you still have another 37 years of working ahead of you. So the total income during your working life is 2.6 million, and the total tax that you'll pay during that time is 530,000. So as you can see, you spend a huge chunk of 17% of your working life paying the tax man. And for all those hard-earned dollars, all that hard-earned time away from families and all those sorts of things, it just eats into what you could be taking home. So that's averaged to be around about 2.5 months that you're working for the ATO per year. So 2.5 months of salary, that's not yours, but there is some things that you can do about that. So by claiming the allowable expenses for holding your property, this reduces your taxable income and maximises your tax savings. So there are a number of items that you can claim depending on your property scenario, and your property mentor will be able to help you with that. By maximising your tax savings, you'll end up with more money in your pocket and less in the tax man's, obviously. So when determining what type of property that you want to purchase, you need to think about what's important to you. We've covered this off in great detail in recent webinars, but for some who may be earning a higher income and find that they're paying a lot in tax, it can be really beneficial to buy a property that is higher in tax savings. So most often this means purchasing a property that costs you more, and this can often scare people away, but you need to look at it realistically and have an open mind, because by the time you take into account the tax savings, these properties can still be cash flow positive. So properties that are likely to save you more in tax include higher depreciation properties, which is units, and newer properties over older properties. We hear all the time that somebody's going to go and buy a second-hand house and they're going to flip it and sell it. And unfortunately, that sort of scenario doesn't work out well for us here in Australia, because when we purchase a property, majority of what we're purchasing is on the land, and it really doesn't matter if it's an old crappy house, you're probably still going to pay close to the same amount if it was a new beautiful home. So what's depreciation and how does it contribute to tax savings? Depreciation is an accounting method that calculates wear and tear of a property over time. So it's calculated as a loss each year, even though there is no physical cost to the owner. So this means at tax time, you claim your depreciation, which remember hasn't actually cost you any money, and you receive a tax offset for the depreciation amount, even though you haven't had to physically pay that. When you purchase a prop with the Property Club, we do help you obtain a depreciation schedule, so you and your accountant know how much depreciation to claim each year. So here's an example of one of Justin and my property. So as you can see, every year has been broken down. And so if we have a look at 2014 to 2015, so we purchased this particular property in October 2014. So for the remainder of that financial year, if you can see in that first rectangle to the right-hand side, we claimed $6,832. Then the next year we claimed $8,039, etc. So essentially that $8,039 comes off the income that we've earned for the year during our normal day-to-day jobs, meaning that we get that tax portion back. And usually it's roughly around 30%. So 30% of $8,000, if I do the maths quickly, is around about $2,400 that we get back, that we haven't actually had to pay anything for. So you can see that depreciation has a real benefit to your property portfolio. Take into account that we then have 5 investment properties, and if we're claiming depreciation on all of those investment properties in any given year, we we often walk away with anything from $10,000 to $15,000 just in depreciation claimed. So positive gearing versus negative gearing, we've probably all heard those terms thrown around a fair bit. So positive gearing simply means that your property is making money after all the expenses are paid, as opposed to making a loss. And negative gearing means that the property is losing money after all the expenses are paid. When you make a loss, you claim that particular loss. So let's say your property brings in $20,000 a year, but it's cost you $25,000 a year, you would claim that $5,000 and get a tax benefit on that $5,000. And again, it means that your taxable income is reduced and that you get either a tax refund or you pay less tax depending on how you manage your tax throughout the year. So let's take a look at some scenarios. So recently we've had a number of properties for sale for our members, and I just want to run you through this particular program and how it works and essentially the information that it gives us. So if you have a look at the red column in this particular chart, you can see that every week this particular property in Chermside is costing our member $355. So that's things like mortgage, it's rates, it's body corporate, all of those expenses. And then their tenant pays $330 a week. So outgoings is $355, incomings is $330, which means our tax savings is $93. And then if you have a look at the mustard coloured column, it's $68 a week ahead just for owning this property. So by owning this property, your bank account is looking better, $68 a week because of those tax savings. So even though the red column outweighs the green column, it's because of the blue column, which is our tax savings, that this property actually works out to be positive. Let's take another look at another example. So this particular property in Parkinson, and taking into account two people's incomes at around 70 grand, $415 a week is going out in expenses. Only $385 a week is coming in, which means our tax savings is around $98 a week, which means again, we're positive at $68 a week for this property. So $68 a week, you have a look at how much that equates over the year. It's just over $5 grand, just for one property. So imagine if you have 5. Then another example in Craigieburn. So Victoria tends to be a bigger loss on property, which means more tax savings. So $422 a week going out, only $321 coming in, and look at those bumper tax savings of $119. A much less surplus than previous examples, but a surplus nonetheless. And that's at $18 a week positive. So just over $6 grand a year just for having this property. Another example in Sydney. So again, same incomes of 70 grand each in a couple. So $410 a week going out, $367 coming in for rent, $129 in tax savings, which means that we are up $85 for this property. So almost $7 grand's worth of tax savings that you would get back at the end of the tax year. So although the expenses appear to be making a loss, by the time you account for your tax savings, these properties are actually cash flow positive, which is a win-win situation. So what you need to remember is that by delaying when you take action, more tax you're paying and losing out on tax savings every year. So if you take a look at Justin and I, we have 5 properties in which we save between $20 and $25 a year in tax. If we didn't have these properties, not only would we miss out on the property growth, but we'd also miss out on that 20 grand per year. So if you think about that, with another 30 working years ahead of us, that's 600,000. And obviously there's inflation, so it will work out to be more. But $600,000 between now and when we retire, that's going to be in our back pocket purely because we invested in property. So not to mention that we've already saved approximately $150,000. So we're really happy with the nest egg that's accumulating for us. Now, for those of you that do have property and it's at that time of year again where it's time to do your tax, here's some quick tips for getting your tax ready. So no shoe boxes. If anybody's pulling out those shoe boxes at the end of the financial year, it's going to be bothersome. So I do suggest that you use a spreadsheet and break down your income and expenses. That's what we do, and in turn that actually saves us money because we do this for our accountant and they only charge us for the time rather than the number of properties that we have. Learn from this year. So if it takes you a while to pull everything together, work out how you can make it more simple next year and get regimented so that next year it's a breeze when you're starting to pull your tax together. Complete little bits of your tax prep throughout the year so it's not all at once. Review your rents. So while all your figures are fresh from pulling all of your information together this time of year, figure out your next move. Think about whether or not you want to get another property and review your property manager. So are you getting what you need? And for those of you in Queensland, reach out to your property mentor and have a chat about some affiliation with the club and some property management that we can help you with. Review your insurances. It's a really good time to remember to check your insurances and make sure that you are covered for everything that you need to be as a landlord. So check out the Property Club insurance. It's landlord insurance that's made for landlords. Do a financial wealth check, which is what we have in the handout section tonight. So again, while all your figures are fresh, get an understanding of your capacity, your financial capacity, so that you know if you can purchase another property and how much you have to spend. But most importantly, figure out your next move. When and where will your next property purchase be? And what type of property do you need to add to your portfolio to maximise its value? So your call to action tonight. First of all, really quick and easy, download your financial wealth check form, download your needs analysis form. So your financial wealth check form is basically a simple form that we send off to one of our brokers for free, and they will do a snapshot of where you are financially and if you've got any capacity to purchase another property. And a needs analysis form essentially sets you up to be able to tell us what type of property you're looking for. It's all about your non-negotiables, what you want and what you need. So all of this is free, and email both forms to YIC, so YIC propertyclub.com.au. So if you take one message away from tonight, stop working for the tax office for 3 months of the year. Get an investment property now so that you're reducing how much of the year you're actually giving to the tax man. Any questions, please email us at yic@propertyclub.com.au, even if you need to know who your property mentor is, and we can make sure that they get in touch with you. Thanks for coming along tonight, guys. See you next month.